Commodities have different types. Among them we can find agricultural, for example, cocoa, coffee, corn, cotton, feeder cattle, hogs, live cattle, lumber, milk, oats, orange juice, palm oil, pork bellies, aka bacon, rapeseed, rough rice, rubber, soybeans, soybean meal, soybean oil, sugar, wheat, and wool. Energy, for example, crude oil, ethanol, natural gas, heating oil, gasoline, propane, and purified terephthalic acid. Number 3, metals. Examples are copper, lead, zinc, tin, aluminum, aluminum alloy, nickel, cobalt, molybdenum, and recycled steel. And number 4, precious metals. For examples, gold, platinum, palladium, and silver. Commodity prices are highly affected by the law of supply and demand, just because they are mostly consumables. Low supply and increased demand raise commodity prices. High supply and low demand lower commodity prices. Since the demand and supply scale constantly changes, so do commodity prices. The prices of many commodities, especially agricultural products, are affected by the natural seasons. For example, corn normally peaks during March and April before the planting season, but dips in September. Weather and lifestyle seasons also affect the demand. For instance, natural gas peaks during winter months because it is used mostly to heat homes. Crude oil prices tend to go up during vacation season because many families take time to travel. Diversity is another main advantage of investing in commodities. With stocks and bonds, general prices rise or fall at the same time, affecting your entire portfolio. Commodity prices, on the other hand, rise and fall at different times. By carefully tracking the seasons, you could adjust your investment strategies appropriately. Commodities remain strong even in bad economic times. Therefore, they afford the investor a natural protection. Most commodities are necessities and their demand does not diminish even in a bad economy. Because of this, prices are more buoyant and can remain springy even when demand falters. Commodities are also natural hedges versus inflation. In fact, when commodity prices rise, it could mean that inflation is starting. If a rapid inflation is reasonably expected, commodity prices are more likely to go up, even faster. In times like this, people normally move their funds to options that offer protection for their assets, like real estate. However, moving them to commodities is much more convenient than investing them in properties. This was the scene in 2008 when the real estate bubble exploded and prices began plummeting. Mortgage-backed bonds and other securities that were dependent on mortgage income quickly lost their value due to loan defaults. This triggered a domino effect on the economy. It substantially depressed consumer confidence and spending, which caused the economy to worsen further. This, in turn, adversely affected the prices of stocks, enough to bring the market down. As people began moving their money out of stocks, bonds, and expectedly real estate, they turned to the commodities market. This pushed the prices of commodities upward and pushed the prices of stocks even lower. This was because the profits of most companies are decreased when commodities are more expensive. A case in point is during the summer and spring of 2008, when oil prices rose 150%. This naturally increased the operating costs of many companies, since just about everyone depends on oil one way or another. That's it for now. On our website you can find more posts as well as savings calculators and other financial tools. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your thoughts, so feel free to share them in the comments below.